Hello viewers, welcome again to Manifested e-learning forum, and today we are going to look at taxation. As I had said earlier, our unit is composed into two parts, that is public finance and advanced taxation. Having concluded the advanced public finance, today we are going to look at advanced taxation. Our first topic will be taxation of advanced aspect of business income. That is taxation of advanced aspect of business income. This is a topic that is meant to equip our finalists with the knowledge of taxing specialized entities. We have a number of specialized entities in the economy, and we need to understand how to tax them. They are supposed to pay taxes to our government, and therefore us as accounting students, we need to have that particular knowledge so that we can be able to know how to calculate their taxable income and their tax liability. These entities include like taxation of partnerships, we have taxation of limited liability companies, we have taxation of charitable trusts, we have taxation of unit trusts, we have taxation of banks, we have taxation of insurance companies, taxation of petroleum companies, we have taxation of real estate investments, we have also taxation of property developers and contractors, we also have taxation of members club, taxation of trade association, as well as taxation of parent companies and subsidiaries and holding companies and the branches. Those are the topics that we are going to cover in this particular topic. But I would like you to understand that at the advanced aspect, we are just looking at these specialized entities. However, there are three major taxes that we need to understand at this particular level. These taxes are, we have compensating tax, we have shortfall tax, and we have corporate tax. We will start with compensating tax, then we move to shortfall tax, and thereafter we move to corporate tax. Corporate tax is the one that is paid by all companies, especially those companies that I highlighted above. But for shortfall tax and compensating tax, they are not paid normally by companies. They are only paid if a company has violated a certain tax law. So to start with, let us start with compensating tax. Compensating tax. As far as compensating tax is concerned, compensating tax is a tax that is paid by companies if they declare dividends from incomes that they were not subjected to corporate tax. And therefore, the government introduced this particular tax back in the year 1993 for the purpose of recovering that particular corporate tax that it misses if the company goes ahead to pay dividend from those incomes that they were not subjected to corporate tax. This tax is calculated by preparing an account known as tax dividend account, known as dividend tax account. Dividend tax account. This account has two sides. It has the debit side and it has the credit side. On the debit side, we have tax refund. We also have dividend paid. On the credit side, we have corporate tax and we have dividend received. Dividend received. Then you are supposed to get the totals of the debit and the totals of the credit. If the debit side is more than the credit side, that is when we experience compensating tax. Compensating tax. And therefore, in few words, compensating tax is the balancing figure of the dividend tax account. So we can put here balancing figure. That way. So in order for us to understand better how to calculate compensating tax, we will do one illustration so that at least we can digest that particular area. The illustration that we are going to cover for this area, it reads like this. The following information was provided by Chamka Remittance for the year ended that 1st December 2017. The dividend that was paid is 21 million. The dividend received is 3.5 million. Profit after tax is 7 million. Tax refund is 3 million. The corporate tax rate is 30%. Required for 4 marks. Calculate compensating tax, if any, payable by Chamka Remittance for the year ended 31st December year 2017. Viewers, what we are supposed to do in this particular question is to prepare the dividend tax account. We capture the items that we are supposed to include on the debit and the items that we are supposed to capture on the credit. Then, if the debit side will be more than the credit side, we are going to conclude that we have a compensating tax. However, there are some other cases whereby you can put these items and you find that the credit side is more than the debit side. In such a scenario, you are supposed to make a conclusion that there is no compensating tax, simply because we only have compensating tax if the dividend we are paying it is more, or the debit side of the dividend tax account is more than the credit side. So let's go ahead and prepare this dividend tax account. The account can do it as follows. Dividend tax account. We have the debit side and we have the credit side. On the debit side, we need to include the tax refund. So tax refund. And in my question, tax refund is 2 million. The other item that we need to capture on the debit is dividend paid. Dividend paid. And for dividend paid, we do not put the figure of the dividend. We put the corporate tax that was deducted on that particular dividend. That corporate tax is calculated by use of the following formula, that is x u multiplied by t all over 1 minus t. So x in this particular case means dividend, and t means the tax rate. So for the dividend that is paid, we have 21 million here. You multiply by the tax rate. The tax rate is 30%. So we have 0.3 divided by 1 minus 0.3. So what we get is the corporate tax that was deducted on this particular dividend. And this can be calculated as follows. So we have 21 million, you multiply by 0.3 divided by 0.7. So you get 9 million. 9 million here. 9 million. Then we move to the credit side. To the credit side, we have the corporate tax. Corporate tax. And for corporate tax, we just need to get the tax rate. We multiply by the profit before tax. In our question, we have profit after tax. And therefore, I expect you understand from the other level that if profit is after tax, it means that profit is equal to 70%. And therefore, to calculate our tax, we will not divide by 100%. We will divide by 70 because our profit is after tax. Therefore, we will get 30%, divide by 70, then we multiply this by 7. And when we multiply that, we'll get 3 million.